Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. For now we see in a mirror dimly, but then face to face. Now I know in part, but then I shall know just as I am known. That was St. Paul, and it kind of reflects, pun intended, how I feel when people ask me to make predictions like, when do you think gold will crack $5,000? I'm certain it will in the relatively near future, but I would never try to put a date on it. There are just too many factors in play. So my crystal ball is more opaque than it is crystal. The reality is economic forecasting is hard. And it's an imperfect science because of the multiplicity of dynamics in play at any given time. For instance, I can tell you that if your state raises the minimum wage, it will increase unemployment at the low end of the wage scale, all other things being equal. However, all other things are never equal, right? It's possible that your state could implement a minimum wage, and due to other policies, employment at the low end of the wage scale actually goes up. And then some talking head somewhere or some policy pundit will point to the numbers and claim, see, Mike, the minimum wage doesn't cause unemployment at all. But it did. We know it did because we understand economics. And when you raise the price of something, demand falls. The laws of supply and demand aren't suspended just because some politician makes a pronouncement. The proper response is the minimum wage did lower employment for lower wage earners, but other policies and dynamics in the market raised it, effectively hiding the negative effects of the minimum wage. Were there not a minimum wage, employment would likely have been even higher. So I'm just using this as an example to demonstrate the complexity of economic and market forecasting. However, given that this is a new year and a lot of people are out there talking about what lies ahead, I thought I would polish off that old crystal ball and offer a few thoughts about where I think precious metals are heading as we move into 2026. So before I dig into all of that, I do want to take a second and thank you for listening to the show. It does mean a lot to me. I say it every week, but I mean it from the bottom of my heart. I know there's so much stuff out there to listen to, and the fact that you choose to listen to this, I appreciate that very much. Now, if you could do me a favor, share these episodes with your friends on your social media. If you're getting value out of it, maybe some of your friends will too. And it'll help us grow the show. And the other thing that you can do that really would help us out is go to wherever you listen to this podcast and write a short review. Give us the stars that you think we deserve, 5. And that also helps, boost the algorithm and will help grow the show. And that would mean a lot to me. So again, thank you for listening. And I do appreciate it. So, talking about the whole idea of economic forecasting and making predictions, somebody who isn't afraid to make bold predictions? Larry Kudlow. Now, you may or may not be familiar with Larry Kudlow. If you're a Fox Business watcher, you probably are. He's a very prominent conservative economic commentator, and he hosts a show over on Fox Business now. He also has served as director of the National Economic Council, the NEC, during the first Trump administration. Now, not trying to be mean, but Kudlow's kind of what I would call a partisan hack. Like, if an administration that he doesn't like is in office, then he will tend to talk the economy down. And when there is an administration that he favors in office, he will talk the economy up. But I think what is most interesting about Kudlow is he famously called the 2008 financial crisis and the Great Recession about a year before it happened. And he recently used the exact same terminology on his show to describe the current economy. Now, in his show, this has been like a week or so ago, Kudlow first referenced the stock market, noting that it continues to hit new record highs. He said, quote, stocks up, taxes down, stocks up, federal regulations down, stocks up, energy prices down. So he's very enthusiastic about the current state of the stock market, apparently. he emphasized the importance of falling oil prices, and this was really kind of the centerpiece of his little talk. He noted that oil permeates virtually the whole economy. And Kudlow also talked up the impact of recent tax cuts. He talked about climbing GDP growth, falling price inflation, and he lauded an ongoing, quote, business boom. And he closed out his commentary proclaiming falling energy prices are going to hand the midterms over to the GOP as long as they sell it. It's the greatest story never told. So that's the key phrase right there. It's the greatest story never told. Now, you're probably thinking, Mike, this doesn't sound like a guy who thinks we're running headlong into an economic crisis. And you're right, he doesn't. And he didn't expect a financial crisis or a Great Recession in 2008 either. In fact, he used that same phrase to describe the 2008 Bush economy, calling it, quote, the greatest story never told. So when I say that he predicted the 2008 financial crisis, I was kind of teasing you a little bit. He actually did the exact opposite. He totally missed it. And he just used that same exact phrase to describe this current economy. In an op-ed that was published by the National Review on December 7th, 2007, Kudlow lauded the Bush economy. Quote, despite all the doom and gloom, he said, from the economic pessimists, the resilient U.S. economy continues moving ahead. And he went on to say that these predictions about economic problems, everybody who was saying that would end up with, quote, egg on their faces. He said, quote, there's no recession coming. The pessimistas are wrong. It's not going to happen. The Bush boom is alive and well. It's finishing up its sixth consecutive year with more to come. Yes, it's still the greatest story never told. I don't know, maybe Kudlow should quit telling stories. We all know what happened less than 1 year later. Now, I'm not writing this to pick on Kudlow. He was far from alone in 2008. In fact, most mainstream pundits and prognosticators insisted at that point everything was fine back in early 2008. You can find a few contrarians, people like Ron Paul, who are out there warning about a financial crisis. But for the most part, late 2007, even early 2008, most people are like, yeah, things look pretty good. No problem. So this underscores a couple of problems when it comes to mainstream economic forecasting on the big networks. The first problem is that people who support the current administration will almost always spin data to try to convince you that the economy is booming. That's their job. Remember all of the talking heads claiming that Biden was bringing down inflation and solving the deficit problem, lauding the Biden economy, the Biden stock market, right? It's the same thing. It just depends on, what your preferred party is. Now, if you listen to the show regularly, you know that I'm not exactly sanguine on the U.S. economy. I do think we are heading towards economic problems, possibly a recession or a financial crisis. But I don't think the U.S. economy is heading toward a cliff because the economic data is signaling a crash, although there are signs. I think the U.S. economy is heading toward a cliff because I've watched this movie before. I understand how the loose monetary policy to stimulate the economy after the dot-com bubble burst blew up a housing bubble in the early O's, setting the stage for 2008. I understand that the Federal Reserve never unwound the extraordinary monetary policy of that era. I understand that the economy was cracking under the weight of rising interest rates in 2019 when the Fed was trying to normalize monetary policy, and then the Fed was forced to pivot to rate cuts and quantitative easing, even before the pandemic, trying to stave off a recession, just like it is today. I understand that the pandemic was a gift for the government because it gave it an excuse to go all in on monetary and fiscal stimulus. That kicked the can down the road. It kicked the inevitable recession down the road. It allowed us to have a little bit more time before we pay the piper for all the malfeasance of 2008. I understand how these decades of easy money have created a giant debt black hole that's dominating the economy today. That's why we see policymakers and pundits screaming for interest rate cuts, even though we still have persistent inflation, because the economy cannot function in a normal interest rate environment because of the giant debt black hole. I understand how this monetary malfeasance fed asset bubbles, incentivized malinvestment, and created an artificial boom. And I know that when you have a boom, there's always a bust. And I've heard a lot of people say this. I think it's true. The bust is usually equal to the boom. If you've got a big boom, you're going to have a big bust. So honestly, I really can't blame Kudlow and others who are convinced that everything is fine. First off, Kudlow is motivated by his political beliefs. But the fact of the matter is the problems right now aren't obvious, right? They are bubbling under the surface as they were in late 2007 and early 2008 when all of the mainstream people were missing what was going on then. But I said, there are signs, right? Gold and silver cruising to record highs day after day. That's telling us something. It's not that gold and silver are just getting more valuable, right? We're watching the decline of the dollar in real time. We're watching the world panic about the financial system in real time. We're watching de-dollarization in real time. That's what this is telling us. It's extremely unusual to see gold and silver rallying at this pace, absent a crisis. This is just the anticipation of the crisis, I believe. But right now, the data looks okay, right? And Trump has done some positive things in terms of tax and regulatory policy, especially regulatory policy. But Trump or any president cannot undo the inevitable effects of nearly 20 years of easy money. A president can't push back bad monetary policy. The best any administration can do is keep the easy money spigot running and cross their fingers that inflation doesn't get too out of control. That's where we are right now. That's what the Fed is trying to do, right? They're trying to walk that tightrope between a crashing economy and out of control inflation. In fact, the Fed's been trying to walk this tightrope for months, but at some point, economics will take control, right? Now, I'm not going to sit here and tell you that the economy is going to tank in 6 months or a year, or even 18 months. That's because I don't know what rabbits the government might pull out of their hats to keep things limping along a little longer. And you never know how events will unfold, right? We were heading for the inevitable crash in 2019. I'm convinced of that. But then the pandemic came along and gave the Federal Reserve and the U.S. government the excuse to launch an unprecedented level of monetary stimulus that basically bailed everything out for a few years. But it looks to me like we're back in that 2019 spot again, as I explained at length in last week's show. If you haven't listened to that show, check it out because I go into depth about how this looks a lot like 2019. So are we going to have another pandemic to bail the government out? Or are we going to have a war? Or who knows, right? But what I do know is that the stage is set because of the underlying macroeconomic dynamics for some serious economic and financial system problems. But as I said at the beginning of the show, my crystal ball is a little bit opaque. Other things could happen. It's possible that the economy will slide into a prolonged period of inflationary stagnation instead of a massive crash or a recession. I've seen some relatively convincing arguments for that case, kind of like Japan did back in the 90s. I don't know. I lean heavily toward a crash, but I can't tell for sure. I just know that there are consequences inherent in the kind of monetary malfeasance that your government and its central bank have unleashed, and you can't dodge them forever. So, that's enough about Larry Kudlow. Let's talk a little bit about precious metals. Can the bulls keep running? That's the question everybody asks, right? We had a big correction right before the new year, and I heard a lot of people, especially relating to the silver market, saying, bubbles popped, precious metals are done. They say that every time that there's any kind of correction. Never forget that corrections are healthy and normal in any bull market. So, last year, amazing year for precious metals. Gold up 64%. It's set 53 new record highs along the way, and we've already set a couple of new record highs this year. Silver last year gained just under 148%. Platinum's price increased by 125.9%, and palladium was up just over 80% on the year. So all of the precious metals did fantastic. But I think the bulls still have plenty of legs left, although we may not see numbers like that again in the coming year. I mean, we might, but I think that this past year was unprecedented. I'm basing a lot of the analysis that I'm going to give now on a report that was put out by Metals Focus. Metals Focus is a London-based independent precious metals consultancy specializing in gold, silver, platinum, palladium, and rhodium markets. And they're kind of mainstream, but they understand the dynamics that support gold and silver, and I typically find their analysis to be very solid. Although they do sometimes understate things that I might emphasize. They don't put as much emphasis on monetary policy as I do, but be that as it may, I think Metals Focus is a good go-to source if you want pretty solid analysis on the precious metals markets. So there were multiple factors that drove metals higher last year, including persistent inflation, uncertainty surrounding U.S. trade and foreign policy, concerns about the long-term outlook of U.S. debt, the ongoing weaponization of the dollar, some shaky economic data, especially in the labor market, and a global trend toward de-dollarization. These are all themes that you have heard on this show. So Metals Focus and I are right on the same page in terms of what has been supporting and driving the precious metals markets. Metals Focus projected that many of these dynamics will persist into 2026, and that seems reasonable, right? Quote, looking ahead, we anticipate further price upside across the precious metals complex as persistent economic and geopolitical uncertainties continue to support portfolio diversification. For the white metals, U.S. tariff uncertainty and favorable underlying fundamentals are likely to provide an additional boost to prices. So they're talking about silver and platinum and palladium. So let's go ahead and look at the metals kind of individually. We'll start with gold. And just looking at last year, after ending 2025 with a significant correction, from over $4,500 an ounce to as low as $4,330, gold rebounded to kick off 2025. It moved back close to the all-time high of $4,550 that hit on December 26th, 2025. And then yesterday, it broke through $4,600 an ounce. That is wild. And it's interesting. Several years ago, I bought my wife a bracelet. It's a 24 karat gold bracelet. So it is not like your typical, jewelry store jewelry. It's investment gold jewelry. And I was looking at the other day, she actually needs to send it in to get repaired. And so we were looking at how much the price has appreciated since I bought it. I bought it for like $150, and it is now priced at like $450. So it just shows you how much gold has gone up. I think that was since 2019. It's wild talking about $4,600 gold. But despite increased volatility, Metals Focus is bullish on gold going into this year, and they project that highs will rise, quote, well above $5,000 an ounce. Quote, in essence, the underlying drivers which drove the gold rally during 2025 will remain in place this year, they said. And they specifically cite regime uncertainty in the U.S. as a factor that will continue to support gold. Regime uncertainty is just when you have leadership that can be erratic. And for whatever good Trump is, you got to admit he can be erratic sometimes, right? He'll shift gears very quickly, and that can be good sometimes for a negotiator. But for people trying to make business plans 2 or 3 years down the road, they're not big fans of regime uncertainty. Metals Focus said, quote, since the start of Trump 2.0, the abrupt and often unpredictable nature of U.S. policy moves has remained a key driver of sentiment toward gold. The organization also expects worries about economic health to support the yellow metal, along with continued monetary easing by the Federal Reserve and probably other global central banks as well. And this is probably one of the biggest factors driving gold higher, in my opinion, right? Despite elevated inflation, the Federal Reserve has cut rates multiple times, and it has actually pivoted back to quantitative easing, which I've talked about in the show before. This is by definition inflation, right? When you have interest rate cuts, what they're trying to do is they're incentivizing borrowing. And when you have a lot of borrowing in a fractional reserve system that is being incentivized by an artificial source, it is very inflationary. And then when you talk about quantitative easing, well, they're literally printing money as they're buying U.S. government debt to support the borrowing and spending. So we have very inflationary policies going on at the Fed. President Trump is going to choose a new Federal Reserve chair this year, here in the next few months. And that individual is likely going to be even more favorable toward loose monetary policy than Jerome Powell, because Trump is a low interest rate guy, which kind of makes sense. He's a real estate developer. He loves low interest rates because he knows that it makes it easier to develop real estate, right? The problem is when you have artificially low interest rates, it also creates a lot of malinvestments that ultimately have to be cleaned out of the economy, which is kind of where we are today. According to Metals Focus, quotes, even if the Fed cuts are less aggressive than markets currently anticipate, the fact that these are still coming will continue to provide support. And they are still coming. The Fed's going to keep cutting, right? Quote, layered over this are worries about persistent fiscal deficits, the rapid accumulation of U.S. debt, and questions surrounding the Fed's independence. These factors raise doubts about long-term debt sustainability and, by extension, the dollar's role as the world reserve currency. You know, if you really sit back and think about that sentence, that's extremely significant, right? The world is worried about the U.S. debt. They're starting to question America's ability to handle that debt. And if you're loaning money to somebody and you start to get worried about their ability to pay you back, what do? You quit lending them money, right? And think about this sentence. These factors raise doubts about long-term debt sustainability, and by extension, it raises doubts about the dollar's role as the world's reserve currency. I'm telling you, ladies and gentlemen, if the dollar falls off of that perch, the United States is going to be in a world of hurt because we depend on the world's demand for dollars to suck up, or I guess I should say soak up, all of the dollars that are created by the central bank and the U.S. government in its borrowing and spending programs, right? The United States needs the world to need dollars. And if the world doesn't need dollars, that's a huge problem. And it doesn't have to even be a situation where, the dollar is suddenly not the reserve currency anymore. Just a small de-dollarization can be extremely problematic for the U.S. economy. Moving along, Metals Focus also expects central bank gold demand to continue supporting the gold market. And I've talked about this a lot on the show. This has been kind of the foundational support for gold demand for the last 3 or 4 years. Central banks have been steadily and aggressively buying gold. So, that's kind of, if you have a pyramid of gold demand, that central bank demand is kind of right there on the bottom, supporting everything else. Central banks globally have increased their gold reserves by over 1,000 tons for 3 straight years. And the World Gold Council projects that 2025 will probably be the 4th year of over 1,000 tons in central bank gold buying. Going back to 2024, it was the 3rd largest expansion of central bank gold reserves on history. 2022 was the highest level of net purchases on record, dating all the way back to 1950. And that includes the suspension of dollar convertibility into gold in 1971. So what we're seeing today in terms of central bank gold buying, we really haven't ever seen this before. To put the last few years into context, central bank gold reserves increased by an average of just 473 tons annually between 2010 and 2021. And there was a time when central banks were actually shedding their gold reserves. But think about that. Today, we're seeing gold buying that is more than double what it was just 3 or 4 years ago. Gold recently overtook U.S. Treasuries as the top global reserve asset. Metals Focus projects, quote, U.S. action in Venezuela and President Trump's aggressive stance toward Greenland, for example, are likely to underpin ongoing de-dollarization. So De-dollarization is a thing, ladies and gentlemen. Sometimes I talk about it and people will roll their eyes and they think it's like some kind of conspiracy theory and like, oh, that can never happen. It's the thing. It's happening right now, right in front of our eyes. Now, there are people out there who overstate it. They'll say, oh, we're going to have, the dollar is no longer going to be the reserve next year. I don't think it's that serious. It's this gradual death by a million paper cuts kind of things, gradual de-dollarization. But as I said, just a modest decline in demand for dollars is a problem for a government that depends on the world getting dollars so that it can keep printing money without creating massive inflation at home, right? Now, looking at the gold market on the other side of the equation, there are some potential headwinds ahead. The higher price will potentially create those headwinds. Quote, "We do not see much support from other gold fundamentals given record prices. Even with firmer retail investment, shrinking jewelry consumption, rising recycling, and increased mine production will lead to a growing market surplus. In keeping with 2025, this surplus will be readily absorbed by strong institutional investment, which will therefore help to drive much of the price upside forecast for this year." So basically, to put that into simpler terms, what they're saying is you're going to see a drop in demand for jewelry for people that are buying that are price sensitive, but you'll probably see that balanced out by increasing demand from institutional investment. And this is especially going to be true if this concept of the 60-20-20 portfolio continues to gain steam. Remember, the CIO over at I think it was Morgan Stanley said that we should consider abandoning the traditional 60-40 portfolio with 40% allocated to bonds and move to a 60-20-20 with 20% of that bond portfolio going away and being replaced with precious metals. If this catches on, man, you're going to see a lot of gold investment because the truth of the matter is, especially here in the United States, there are a lot of investors out there that have zero exposure to gold, and most have less than 1% to 2%, nowhere near 20%. So, if we even start moving slightly in that direction, it could really boost gold investment. Okay, so that's gold. Let's talk a little bit about silver. The same macro dynamics that are driving gold higher should also support silver in 2026. So the geopolitical uncertainty, Fed rate cuts, things like that. But much more of silver's demand comes from industrial offtake compared to gold. So that makes the dynamics in the silver market a little bit different. But that being said, at its core, silver is still a monetary metal. I know it's not being bought by central banks. It's not being used as money, but the perception globally is that silver is a monetary metal, and it does generally track with gold over time. If you look at a long-term chart of gold and silver, you'll see that they tend to rise and fall broadly together, with silver having a lot more volatility because of that increased industrial demand. Metals Focus anticipates some price pressure early in the year due to profit taking and liquidations linked to index rebalancing. But while Metals Focused analysts actually think there could even be a sharp correction, like back down towards $50, they anticipate that will be relatively short-lived. Quote, "We expect a recovery to soon emerge, with silver poised to achieve new all-time highs." So that would be over $80. So bottom line is, if you see a big correction in silver, don't necessarily panic, because there are these dynamics that are in place that are supporting the market. Along with the geopolitical and macroeconomic factors that I've already highlighted for the gold market, the silver market has one overwhelming dynamic driving it forward, and that is there simply isn't enough metal. And I've talked about this often on the show, but I think it's extremely important. I mean, this is the key to understanding the silver market right now. Silver demand has outstripped silver supply 4 straight years, and the Silver Institute projects that 2025 will be the 5th market deficit. The structural market deficit for last year, 2024, not 2025, was 148.9 million ounces. So what I'm saying is that the people who use silver users, they consumed 148.9 million more ounces of silver than were mined and obtained through recycling. So that means that those folks had to go to existing above ground stocks to source their silver. And people that already have that silver, they're typically reluctant to let it go. They have to have a higher price to be willing to sell. So that's part of the reason that you're seeing this steady upward price pressure on silver. So 2024 drove the 4-year market shortfall to 678 million ounces. We're going to add probably another 100 million ounces or so to that for 2025. That's going to bring the total market deficit, the amount of silver that was used beyond what was mined, to the equivalent of basically 1 year of mining supply. Pretty amazing. So we've seen this ongoing silver squeeze developed in recent months. I've talked about it on the show. I've written a couple of articles about it. I'll post a couple of articles on the show notes page to help you better understand what we mean by a silver squeeze. But kind of the short version is it started when metal moved from London to New York back in April, driven by tariff worries. So that displacement of metal, coupled with surging Indian demand, set off the first squeeze back in October, which drove the silver price to over $50 for the first time. So with that squeeze and with the price dynamics, metals finally did flow back to London, but that didn't solve the underlying problem, right? Shuffling silver between London, New York, and India, it took the immediate pressure off the market, but it didn't magically create new silver. And it didn't take long before Silver Squeeze 2.0 developed late last year, which briefly pushed the price over $80 an ounce. And we're still seeing these aggressive squeezes where the price goes up and up. And I'm convinced that people are trying to source this metal. I wrote an article this week looking at the futures market and some interesting dynamics that are going on there that may also signal this ongoing squeeze. I'll link to that in the show notes as well. Metals Focus expects the metal shortage to persist as demand remains robust. Quote, physical liquidity in the London market is likely to remain tight in the coming weeks, driven by strong investment demand, tariff uncertainty, keeping substantial silver stocks in the U.S., refining capacity bottlenecks, and a structural deficit. Given silver's smaller market size, these factors may well amplify price movements, with a 3-digit peak looking likely this year. So, to put it simply, Metals Focus is expecting gold to go over $5,000 and silver to be over $100 at some point in the coming year. Now, Metals Focus does expect some significant demand pressure in the silver market at the higher price. Quote, following silver's exceptional price gains, efforts to reduce silver usage in the industrial space are likely to accelerate. That said, the impact of these demand losses is likely to be mitigated by continued strong investment demand. Kind of like what we're seeing in gold. Less jewelry demand because prices are high, but more investment demand because prices are high. And from what I'm told, when we talk about substitution, yes, there are ongoing efforts, especially in the solar field that uses a lot of silver. They're looking for ways to replace it with cheaper alternatives, copper or other metals. The problem is that you can't retool a factory tomorrow, right? You can't say, well, we want to start using a different thing in these solar panels. So, flip this switch and switch the factory. It doesn't work like that. It takes time. So even if there are successful efforts to lower silver's demand in the industrial sector, it's going to take a while for that to play out. And the fact of the matter is, the reason they use silver is because it is the best at doing what it does. It is the best conductor of electricity at room temperatures. So difficult to replace it. Not impossible, but I think sometimes the worries about industrial demand just suddenly evaporating are a little bit overstated. So yeah, and while we're talking about silver, how would you like to get some under spot price? You can do it. Because at Money Metals, we have junk silver that we're selling under spot right now. Now, when I talk about junk silver, I mean quarters, dimes, half dollars that were minted prior to 1965. So if you have a quarter or a dime or half dollar and it says 1964 or earlier, it's 90% silver. And the melt value of those they're worth a lot more than a quarter, right? I haven't looked recently, but melt values for those silver quarters have been over $12. So that's just one quarter. And we are selling this junk silver at under spot price even now. So that's a great way to get yourself exposure to silver if that's something that you're interested in doing. You might want to talk to a money metals, precious metals specialist, or you can just go to moneymetals.com and find the junk silver. Just search for it. Go to the silver. It's right there in the navigation menu. Something to think about, because not a bad time to get some silver, especially if you can get it under spot price. So I was going to dive into the platinum and palladium markets. However, I'm running out of time, and I don't want this podcast to go on forever. Just kind of to sum up, Metals Focus is also bullish on both of those metals as well, especially early in the year, although they do see some downside potential later in the year. It's important to remember with platinum and palladium, they are much less influenced by the monetary aspects, although like all commodities, they will tend to do well in an inflationary environment. Because keep in mind, what inflation really is, it's the devaluation of your money. So when you see gold and silver, platinum, grain, oil, a lot of times those things will go up in price simply because the dollar is losing value, right? It takes more dollars to buy something as the dollar depreciates. So that will always be a factor with palladium and platinum, but they're not considered monetary metals, so you don't see the central bank demand. They don't necessarily track with gold in the same way that silver does. But definitely want to keep your eye on platinum and palladium as well, and that might be another way to kind of diversify your precious metals portfolio. But here's the bottom line. I think you do want to have a precious metals portfolio at this point. You know, it's amazing to me that so many people don't. I think that, and my boss, Stephen Gleason, the CEO here at Money Metals, he says this a lot. It's professional malfeasance not to recommend professional or precious metals at this point if you're an investment advisor. And there's such a bias against gold and silver. He wrote a little article about it. I'll post that on the show notes page as well. But you want to have a precious metals portfolio, right? You want to have real money. When the government and the central bank are destroying your fiat money, you want to save in real money, gold and silver, and you can do that. Make the call today, 800-800-1865. Talk to a money metals, precious metals specialist. Ask them questions. They will give you the information that you need, help you get started if you never have in precious metals investing. We do have some programs that can help folks who may be thinking, man, I just don't have, a lot of money that I can sink into savings and investment right now. Well, you really can't afford not to save and invest in the big picture. And one thing that you can do is check out our monthly program where you can build a precious metals portfolio over time with as little as $100 a month. There are ways to do it. Where there's a will, there's a way. So do it today. Don't put it off. 800-800-1865, or you can just go to moneymetals.com. You can chat with the precious metals specialist there in a chat, or if you know what you want, don't call anybody. In fact, I know that the phones have been pretty busy, so if you know what you want, you can just go to moneymetals.com, pick what you want, buy it, we'll ship it out to you, and you'll be happy. So with that, we're going to call that a wrap for this episode of the Midweek Memo podcast. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and join a million other people, literally, that are on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also have the opportunity to tune into our Market Wrap podcast that airs every Friday, where you're going to get a quick 10 or 15-minute overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold, silver, economics, and investing. Thank you again so much for listening to this show. I do again appreciate it. Please remember to share the episodes and give us those reviews. I hope you have a fantastic rest of your week, a great weekend, and I will be back here again to talk to you all next Wednesday.